Silver did not jump to 82 because retail traders suddenly got excited. It jumped because a supply war is now underway between the United States and China, and the battlefield is not the futures chart. The battlefield is the real metal, the mines, the refineries, the shipping routes, the private contracts nobody on television wants to talk about. And if you understand what is happening beneath the surface, then the drop from 121 to 64 stops looking like the end of a bull market and starts looking like a distraction while two superpowers race to lock up silver for the next generation. That is the real story. Not the paper volatility, not the daily noise, not the commentators asking whether silver moved too far too fast. The real story is who is getting the metal, who is losing access to it, and why the visible market is now far smaller than most people realize. If you are new here, subscribe, because the mainstream still treats silver like a side character, when in reality, it is becoming one of the most strategic assets in the world. And tell me in the comments where you are watching from, because I want to know how far this signal is reaching before the crowd catches on. Most people look at silver backward. They start with the exchange. They start with the quote on the screen. They start with the vault reports in New York or London. That is the wrong place to begin. If you want to understand a tightening market, you do not start where the metal ends up. You start where the metal is born. So ask the question that almost nobody asks. Before silver becomes a bar, before it becomes inventory, before it becomes a futures contract, where does it actually come from? It comes from Latin America, Mexico, Peru, Bolivia, Chile, Argentina. That belt is the heart of global mined silver supply. Mexico alone sits at the top of the pyramid. Peru is right behind it. Together, those two countries represent a massive share of the world's primary flow. That means if you control the upstream in Latin America, you do not just buy silver. You influence the whole market before the public even sees it. For years, while most investors were staring at candles on a chart, China was playing a completely different game. They were not waiting for silver to show up on public exchanges. They were not lining up with everyone else in transparent markets where price discovery actually happens. They were moving earlier in the chain, closer to the source, closer to the mine, closer to the raw material. They went directly to producers and locked in supply with long-term offtake agreements. Not little spot purchases, not opportunistic trades, long-duration deals that allowed them to secure silver concentrate and doré before that metal ever had a chance to reach the broader market. Think about what that means in practical terms. A mining company pulls ore from the ground. Usually that material moves into refining channels that feed visible supply. It gets processed, reported, shipped, tracked, and eventually some of it lands in places the market can measure. But if a buyer intercepts that flow upstream and says, "We will take the output now, we will refine it ourselves, and we will guarantee the purchase in advance," then that silver disappears from the visible pipeline before anyone else even has the opportunity to compete for it. If you are a miner in Peru or Mexico, and someone offers a premium, long-term certainty, guaranteed demand, and faster capital recovery, that is hard to refuse. The producer gets stability. China gets control. Everybody looking only at exchange inventories gets fooled because the metal never shows up where they expect it. This is why so many people underestimated the tightening. They were counting only what remained visible. They were ignoring the huge volume of silver being rerouted before it ever became public supply. Because this was never just about buying silver. It was about building a private artery from Latin America into China's own refining machine. It was about upstream capture. It was about securing the feedstock before the West could touch it. That is not ordinary commodity procurement. That is strategic positioning. Now here is where the story turns. Something shifted. Not gradually, not quietly. Something changed hard enough that the physical flow itself began to look different. And from everything I can piece together, that turn happened in the second half of 2025. The United States started pulling the metal back. Not with a speech, not with a slogan, with actual flow, with physical movement, with refining behavior that suddenly stopped looking normal. Silver concentrate from Latin America began landing in unusually large quantities at U.S. refiners. So much, in fact, that processing capacity became strained. Material was coming in faster than it could be turned into finished product. That is not the footprint of a casual buyer. That is the footprint of urgency. Read that again in your mind. Silver was arriving faster than the system could comfortably refine it. That matters because supply chains do not flip by accident. If metal that would historically flow elsewhere suddenly starts piling into the United States, someone made a decision. maybe several someones. Private capital, strategic buyers, industrial users, possibly policy-adjacent actors. Whatever the exact mix, the effect is the same. The Western Hemisphere's silver began staying closer to home. And if China's edge over the last several years came from intercepting supply before it reached the open market, then America's countermove appears to be straightforward. Get to the source, secure the flow, absorb the concentrate, keep the metal inside the Western orbit, starve the rival of easy access. That is why this no longer looks like commodity trading. And once a metal enters that category, price alone stops explaining behavior. Nations do not think the way traders think. Traders hedge, nations secure. Traders optimize, nations accumulate. Traders panic over drawdowns. Nations worry about losing strategic access for a decade. Take Black Friday 2025. That day was one of those moments when the surface action looked chaotic, but the deeper signal was even more important. A major bullion institution effectively removed available silver from circulation. Supply that traders assumed would remain accessible suddenly was not. And what followed looked less like normal repositioning and more like a scramble by a structurally exposed Chinese participant that needed metal fast. Not paper, metal. That is the key difference. A short can survive many things in a derivative market. What a short cannot survive is a tightening physical market when deliverable supply gets yanked away. Then price becomes secondary. Access becomes everything. And when the biggest financial hands in America can constrict supply while a major Asian buyer is forced into aggressive coverage, you are not watching random volatility. You are watching pressure applied at the exact point where physical weakness hurts the most. This is how modern commodity conflict works. No tanks, no speeches, just vanishing inventory, rerouted cargoes, choked refining capacity, and counterparties suddenly willing to pay up because they do not have time. In the 19th century, America declared the Western Hemisphere its sphere. 2 centuries later, that same logic appears to be re-emerging, not through military occupation, but through commercial dominance over critical resources. Latin American silver is not just ore anymore. It is leverage. It is industrial input. It is monetary collateral. It is geopolitical influence in metallic form. So when the United States pulls more of that flow into its own refining orbit, the message is obvious. This supply matters. This region matters. And losing control of that pipeline is no longer acceptable. But the most explosive clue in the entire story is not the flow itself. It is the disappearance of hedging. This is the point where the thesis goes from interesting to stunning. In a normal commodity market, large buyers hedge exposure. That is textbook behavior. If you are securing material at scale, you protect yourself against price swings. You lock in margins. You reduce uncertainty. That is what rational commercial participants do when price matters more than possession. But what happens when hedging falls away? It means the buyer is telling you something very important. They are no longer prioritizing the price. They are prioritizing ownership. They want the silver itself, in hand, in vault, under control, available when needed. If it falls next week, they do not care. If it rises next week, they still do not care. The mission is not performance. The mission is acquisition. That kind of demand is different. It is deeper, harder, more dangerous for anyone betting on easy supply. Because a buyer who wants exposure can step back when the chart turns ugly. A buyer who needs possession cannot. A buyer who wants upside can wait for a dip. A buyer who needs control of the metal must act even when the price is uncomfortable. That is why the drop in commercial hedging is so important. It suggests the market is no longer dominated by participants thinking in quarters. It suggests that strategic actors are thinking in years. Prices move before official policy becomes visible. By the time a government announces a framework, the private flow has often already changed. By the time a tariff is made public, smart money has already started repositioning. By the time television notices the shortage, the metal has already moved. That is why silver can reprice aggressively without a giant headline explaining it. The physical system senses the change before politicians say it out loud. Now look at China's side of the board. If you had spent years building upstream access in Latin America, and then that access started tightening, what would you do? You would go downstream and bid for finished metal instead. And that is exactly what appears to be happening. Chinese buyers have reportedly shown willingness to pay large premiums over spot for refined, deliverable silver. Not raw concentrate, not partially processed feedstock, finished silver, ready metal. the kind you chase only when the earlier stages of the supply chain are no longer giving you what you need. Confident buyers do not lunge for finished metal at elevated premiums unless something underneath them is breaking. That behavior screams urgency. It says the pipeline is no longer secure. It says upstream control is slipping. It says access is deteriorating fast enough that price sensitivity is being thrown out the window. That move tells the same story from another angle. When a country restricts outward flow, that is usually not the move of a player sitting comfortably on abundant supply. That is the move of a player trying to conserve what remains available internally. It is defensive, protective. It says we cannot afford to let too much leave because what is coming in may not be enough. A lot of people misunderstand how Section 232 logic works. They think policy starts the move. Often it is the opposite. First the material is secured, then the market adjusts. Then policy comes later to formalize the advantage that the supply chain already created. That is why metals can surge before a tariff is announced. The market is not stupid. It tries to front-run the policy architecture implied by physical behavior. If domestic or hemispheric supply is being consolidated first, then tariffs become the lock on a door that was already being closed. And when major banks openly flag that possibility, you should pay attention. Institutions do not model these scenarios for entertainment. They model them because the consequences for price and flow could be enormous. Silver is no longer only an industrial metal or a retail precious metal. It is increasingly starting to look like collateral in a world that trusts old monetary plumbing less and less. A de-dollarizing world needs real assets, not theories, not promises, not balance sheet magic. Tangible things that can back obligations when trust gets thin. Gold is the obvious first choice. Everybody knows that. Central banks know that. Sovereign buyers know that. That is why gold has been hoarded so aggressively. But gold is not infinitely available. Accessible, unencumbered gold is limited. And once enough serious players compete for the same pool, the search naturally expands to the next credible tier of tangible collateral. And once silver starts being accumulated not just for electronics or jewelry or coins, but as a reserve-adjacent asset, the demand profile changes completely. Now you are no longer dealing with a market served only by industrial users and retail buyers. Now you are adding sovereign logic, strategic logic, balance sheet logic, collateral logic. That is a bigger pool of demand chasing the same constrained supply, and the supply is not expanding on command. Mine development takes years. New output cannot just appear because the price moved. Refining capacity has bottlenecks. Visible inventories are already thin. Deficits have persisted. And the bigger the strategic premium becomes, the less likely existing holders are to part with what they own. So step back and look at the full convergence. The United States appears to be pulling Latin American silver back into its own orbit. China's upstream edge appears to be under pressure. U.S. refiners are receiving enough material to strain capacity. Hedging is fading, which signals buyers want possession more than price protection. Chinese buyers are reportedly paying aggressive premiums for finished metal. Export controls suggest defensive behavior. Tariff scenarios are being seriously modeled. Gold is being accumulated at a pace that pushes collateral thinking towards silver. Visible inventories remain stressed, and the market is trying to price all of this, while many investors are still arguing about chart patterns. And no, that does not mean the path will be smooth. It probably will not. A market like this can be brutally volatile because volatility becomes a weapon. Shake weak hands, trigger emotional selling, force participants to focus on the ticker instead of the flow. Who has the metal? Who needs more of it? Who is losing access? Who is willing to pay up? Who is hedging less because control matters more than cost? And here is the scenario very few people are gaming out properly. If America formalizes this shift with tariffs or a broader critical mineral framework, domestic silver could begin trading with a persistent premium versus international benchmarks. That premium would pull even more Western Hemisphere supply toward the U.S. London and Shanghai would feel the drain harder. Public exchanges would become even less representative of the true private struggle for metal. In other words, policy would not create the war. It would merely reveal that the war was already underway. That is why the crash from 121 to 64 may one day look trivial in hindsight. People remember the drama of the drop because it was loud. But history often cares more about the quiet pivot that followed. The moment when silver stopped behaving like a sleepy precious metal and started behaving like a strategic asset contested by major powers. To industry, to governments, to supply chains, to a world that is becoming less trusting, more fragmented, more regional, and more desperate to secure tangible things before the next shock hits. Watch U.S. refining bottlenecks. If they continue, the reshoring of flow is real. Watch Chinese premiums over spot. If those premiums rise again, desperation is not fading, it is intensifying. Watch any signal around Section 232 or broader critical mineral policy. Do not treat it like background noise. Treat it like confirmation that supply control is becoming official doctrine. Watch exchange inventories in both the West and Asia. If both sides keep draining, the competition is getting sharper, not softer. And watch the gold-silver relationship. If gold continues to attract sovereign accumulation and silver begins catching the collateral bid underneath it, the repricing could accelerate faster than most models expect. This is not just a story about a metal, it is a story about power, about access, about what happens when two giant systems realize that the same material is more important than they previously admitted. One side spent years building the upstream advantage. The other side appears to be clawing that advantage back. And the market sitting in the middle is still pretending this is just another commodity cycle. It is a fight over control of a strategic asset in a world where control is becoming everything. So tell me this in the comments. Do you think the United States is truly taking Latin American silver back from China? Or do you think China still has another move the market has not priced in yet? And second, if silver is shifting from investment metal to geopolitical collateral, what do you think that means for price over the next few years? Subscribe if you want the real signals, not the sanitized version after the move is already over. Because this story is not finished, it is just getting started. And the people waiting for the mainstream to explain it are going to be the last ones to understand what happened.